Welcome to my YouTube channel. Subscribe for more awesome content, and don't forget to like this video.
Right now, you might have a few $100s in your bank account. Maybe $500. Maybe $800. But somewhere in the world, a hedge fund trader just made that amount in a few seconds. At the same time, a government somewhere created billions of dollars simply by updating numbers in a computer system. And inside massive office towers in places like Wall Street, young financial analysts are structuring deals that can determine the future of entire companies. All of this happens every day. Yet most people were never taught how this system actually works. Schools rarely explain it, which means there is a huge gap between people who understand money and people who simply use it. Today, we're going to close that gap. In this video, we'll explore how the global financial system really works, from the first forms of money thousands of years ago to the digital currencies governments are developing today. The strange truth about money. Let's start with something surprising. Money itself has almost no real value. Take a $100 bill. The paper and ink used to produce it are worth only a few cents, yet we treat it as something valuable. Why? Because society agrees that it is. Money works because billions of people share the same belief that it represents value. It is essentially one of the most successful agreements humanity has ever created. Life before money. Before money existed, people traded goods through barter. If you had wheat and needed shoes, you had to find someone who both wanted wheat and had shoes to offer. Economists call this the double coincidence of wants problem. If the two needs didn't match, no trade happened. That made economic growth very slow. To solve this problem, societies began using items that everyone accepted as valuable. In different regions, people used things like shells, salt, livestock, or tobacco. Eventually, civilizations began creating standardized coins. One of the earliest examples appeared around 700 BC in the ancient kingdom of Lydia, located in modern-day Turkey. For the first time, people could carry wealth easily and trade efficiently. The birth of paper currency. Centuries later, a major innovation arrived: paper currency. This idea first appeared in China more than 1,000 years ago. Instead of carrying heavy metal coins, merchants began exchanging certificates that represented stored value. Travelers like Marco Polo described the system when they returned to Europe, where people initially found it hard to believe. But eventually, the idea spread across the world. For a long time, paper money was tied to gold. Governments promised that each note could be exchanged for a fixed amount of precious metal. This system was known as the gold standard. When money became fiat, everything changed in 1971. That year, U.S. President Richard Nixon ended the direct link between the U.S. dollar and gold. After that moment, the dollar, and most global currencies, were no longer backed by precious metals. Instead, they became fiat currencies. The word fiat comes from Latin and means "let it be done." In simple terms, money has value because governments declare it does, and because people trust that declaration. Today, the majority of money isn't even physical. Only about 8% of the world's money exists as cash. The rest exists as digital numbers stored in bank databases. When you check your bank balance on your phone, you're not seeing actual piles of cash. You're looking at digital records. The institutions that control money. Every modern economy has a central bank that manages its monetary system. In the United States, that institution is the Federal Reserve. Central banks don't serve everyday customers. Instead, they oversee the financial system and regulate banks. They control the economy using several powerful tools. One of the most important tools is interest rates. By raising or lowering borrowing costs, central banks influence spending, investment, and economic growth. Higher rates slow the economy. Lower rates encourage borrowing and spending. Another major tool is known as quantitative easing. This occurs when central banks purchase large amounts of government bonds or financial assets to inject money into the financial system. After the global financial crisis and the COVID-19 pandemic, these policies expanded dramatically. In just a few years, trillions of dollars were created to stabilize economies. How banks actually create money. Here's something that surprises many people. When you deposit money into a bank, it doesn't simply sit in a vault. Banks use most of those deposits to make loans. This system is called fractional reserve banking. For example, if you deposit $1,000, the bank might lend most of it to someone else as a loan. That loan then gets spent and deposited again somewhere else. Through this process, money effectively multiplies within the financial system. In modern banking, new money is often created when loans are issued. When someone receives a mortgage or business loan, that money didn't necessarily exist beforehand. It is created through the lending process. This is one reason why credit expansions and credit contractions have such a huge impact on economies. The fragility of the banking system. Because banks lend out most deposits, they rely heavily on trust. If too many customers try to withdraw their money at the same time, banks may not have enough cash available. This situation is called a bank run. To prevent financial panic, governments created insurance systems like the FDIC. This organization protects deposits up to a certain limit, helping maintain confidence in the banking system. However, modern technology has changed how quickly panic can spread. In today's digital world, billions of dollars can move in seconds. Bank runs that once took weeks can now happen in a single day. The financial system today. Behind the scenes, enormous institutions move trillions of dollars through markets, investments, and global trade. Commercial banks manage everyday accounts, investment banks structure massive deals for corporations and governments, and financial markets determine the value of assets across the world. Together, they form the complex system that powers the global economy. The key lesson. The most important thing to understand is this. Money is not just coins and paper. It is a system built on trust, agreements, and financial institutions. Those who understand how the system works are often able to use it to build wealth. Those who don't are simply participants within it. Learning how money actually functions may be one of the most valuable financial skills anyone can develop.